Gold just posted its largest daily swing in market cap in history, $5.5 trillion, between 9:30 a.m. Eastern and 10:25 a.m. Eastern. Gold lost $3.2 trillion in market cap. That's $58 billion per minute. Then between 10:25 a.m. and 4:00 p.m. Eastern, gold added back $2.3 trillion. That's over 3 times the entire market cap of Bitcoin swung in 6.5 hours. $850 billion per hour in market cap movement. We are witnessing one of the most historic trading opportunities of all time. Gold's volatility is now above 2008 crisis levels. Mrs. Currency here. Stats show about 75% of you aren't subbed yet. If this unfiltered edge is actually sharpening your view, smash subscribe so I know the committed squad is here. If it's not adding real value, don't. I don't chase numbers or beg. I want a real community, not another mainstream echo chamber. Now, here's where this story gets absolutely wild. Just last week, Goldman Sachs set their gold target at $5,400 1 week ago. Yesterday, Deutsche Bank came out with a $6,000 target. Today, JP Morgan published analysis plotting a path to $8,500 per ounce. Goldman's target from 7 days ago has already been exceeded by reality. And now JP Morgan is calling for another 52% upside from current levels. JP Morgan analyst Nicholas Penglu laid out the thesis. Gold could keep rallying as private investors increase allocations from 3% to 4.6% of portfolios, potentially pushing prices to $8,000 to $8,500 per ounce. The analyst notes that gold recently hit $5,600 amid safe haven demand, central bank buying, and a shift away from long-term bonds. Let me break down what that 3% to 4.6% allocation shift actually means. That's a 1.6 percentage point increase in household portfolio allocation to gold. Sounds small, right? It's not. The global investable asset base for households is somewhere in the range of $200 trillion. A 1.6% shift means $3.2 trillion of incremental demand flowing into a gold market with a total market cap around $40 trillion. That's massive marginal demand hitting a market that's already tight. And here's the critical detail. While momentum may spark short-term profit-taking, according to JP Morgan, gold shows stronger liquidity and breadth than silver or Bitcoin. Gold is becoming the primary monetary safe haven for large institutional and household money. When you're moving billions or trillions, you need depth and liquidity. Gold has it. Silver's market is smaller. Bitcoin's market is more volatile and less liquid at scale. Gold is winning the institutional allocation war. Now, connect the dots to what just happened today. $58 billion per minute was getting obliterated from gold's market cap during the crash. Then, $850 billion per hour was flowing back in during the recovery. That is not normal price discovery. That is forced liquidation followed by panic buying. That is leverage getting flushed and then real money rushing back in. That is the system straining under the weight of positioning that has become completely disconnected from physical fundamentals. Gold's volatility is now above 2008 levels. Let that sink in. 2008 was the global financial crisis. Lehman Brothers collapsing, the entire banking system on the edge of implosion, and we just exceeded that volatility in gold. What does that tell you about the stress in the system right now? What does that tell you about the leverage? What does that tell you about the fragility of the pricing mechanism? The fact that major banks are revising their gold targets higher by thousands of dollars within days of each other tells you they're chasing the market, not leading it. Goldman called 5,400 last week, already blown through. Deutsche called 6,000 yesterday. We're approaching it. JP Morgan calls 8,500 today. The targets keep getting revised because the fundamentals keep getting stronger and the price keeps defying the old models. These aren't fringe analysts or permables screaming into the void. This is Goldman Sachs. This is Deutsche Bank. This is JP Morgan. The 3 largest investment banks on the planet are now publicly acknowledging that gold could reach $8,000 to $8,500. And they're doing it because they're seeing what we've been tracking for months. Central bank buying, safe haven flows, portfolio reallocation, dollar debasement concerns, geopolitical fragmentation, and a complete loss of confidence in long-duration bonds. The shift from long-term bonds to gold that JP Morgan mentioned is enormous. For decades, long bonds were the safe haven. Treasuries were the flight to quality trade. But with deficits exploding, debt to GDP ratios at historic highs, and inflation concerns persistent, that old playbook is breaking. Households and institutions are reallocating from bonds to gold, And we're only at 3% portfolio allocation. If that goes to 4.6%, 6% like JP Morgan projects, you're looking at trillions in incremental demand. Now let's talk about what could go wrong here, because after a day like today, the risks are very real. We just saw volatility above 2008 crisis levels. If you're trading gold on leverage, if you're in futures or options, if you have tight stops, this kind of environment will destroy you. 58 billion per minute getting erased means margin calls hit instantly. Your position gets liquidated before you can even react. That's the reality of trading in this volatility regime. JP Morgan themselves noted that momentum may spark short-term profit-taking after a move from 3,000 to 5,600 in a relatively short period. Pullbacks are normal. Corrections are healthy. If we see another wave of selling like this morning, we could easily give back another $1,000 before the next leg higher. The path to 8,500 is not going to be a straight line. It's going to be violent, choppy, and full of liquidation events like today. And here's the other risk. If equity markets continue to sell off, if we see a true risk-off panic where people are scrambling for cash and liquidity, gold can get dragged down in the initial move. It happened in 2008. It happened in March 2020. Even though gold is a safe haven, in the very early stages of a liquidity crisis, everything sells off as people meet margin calls and raise cash. Then gold rebounds as the safe haven bid returns, and central banks flood the system with liquidity. So, if you're over-leveraged, if you don't have a plan for volatility, if you're trading on emotion, this market will wreck you. The swings are too violent, the moves are too fast. You need to size positions appropriately. You need to understand your risk tolerance. You need to have cash on the sidelines to take advantage of dips, rather than being forced to sell into them. But here's why the bearish case, while real for traders and short-term positioning, doesn't change the long-term structural thesis. Every single factor driving gold higher is still in place. And accelerating. Central banks are still buying. According to multiple reports over the last year, central banks have been accumulating gold at the fastest pace in decades. China, Russia, India, Turkey, Poland, all adding to reserves. That's not speculation. That's verifiable data from official sources. Safe haven demand is surging. JP Morgan explicitly cited this in their analysis. Geopolitical tensions, dollar weaponization concerns, and a multipolar world emerging all drive safe haven flows to gold. The BRICS nations are actively working to reduce dollar dependence. That means increasing gold reserves. That's structural demand that's not going away. Portfolio reallocation is just beginning. We're at 3% household allocation to gold. If JP Morgan is right and that goes to 4.6%, that's 3.2 trillion in incremental demand. And honestly, 4.6%, 6% might be conservative. If we see a real crisis of confidence in fiat currencies or sovereign debt, that allocation could go much higher. And here's the kicker. Gold shows stronger liquidity and breadth than silver or Bitcoin, according to JP Morgan. That means as institutional money and household wealth looks for safe havens, gold is the primary beneficiary. Silver has a smaller market and higher industrial exposure. Bitcoin has volatility and regulatory uncertainty. Gold is the incumbent monetary safe haven, and it's reasserting that role right now. The 58 billion per minute that got erased this morning that came back as 850 billion per hour during the recovery. The market absorbed the crash and reversed it in the same day. That's not a sign of a broken bull market. That's a sign of underlying demand so strong that even forced liquidation events get bought immediately. So where does this leave us? 3 key takeaways, and we're out. Number 1. Gold just experienced the largest daily market cap swing in history at $5.5 trillion. Volatility is above 2008 crisis levels. We are in a completely new regime where a $40 trillion asset is moving with the violence of a speculative market. That creates both enormous risk for over-leveraged traders and enormous opportunity for those positioned correctly. Number 2, the major banks are revising targets higher in real time and can't keep up with the move. Goldman 5,400 last week already blown through. Deutsche 6,000 yesterday almost there. JP Morgan 8,500 today. The thesis is portfolio reallocation from 3% to 4.6%, which represents 3.2 trillion in incremental demand. If that happens, the path to 8,500 becomes very plausible. Number 3. Gold is winning the institutional allocation war. JP Morgan explicitly stated that gold shows stronger liquidity and breadth than silver or Bitcoin. As safe haven demand surges, as central banks buy, as households reallocate from bonds, gold is the primary beneficiary. The old safe haven trade of long duration treasuries is breaking down and gold is filling that void. The unresolved tension is this: can the market handle this level of volatility without a major liquidation event that takes us significantly lower before we go higher? And if portfolio allocation does shift from 3 to 4.6% like JP Morgan projects, how fast does that capital flow in? And what does price discovery look like in a market that's already this volatile? We're living through a historic moment, the largest daily swing in gold market cap ever recorded, volatility above financial crisis levels, major banks revising targets by thousands of dollars within days. This is not normal. This is not stable. This is a market in transition from one regime to another. The old models are breaking. The new models are still being written. Do your own due diligence. Understand the risks. If you're trading on leverage in this environment, you're playing with fire. If you're building physical with a long-term view and appropriate position sizing, this volatility might just be the shakeout before the next major leg higher. Time will tell. Invest with logic, not hype. BC out and about.